Hi, this video is about why the investment horizon of the investor should be similar to the holding period of a mutual fund. Now, the reason for that is that so firstly, what is the investment horizon of the investor? That's the time period that an investor will stay invested in the mutual funds. And what is the holding period of the of an investment? That's the minimum time period that you should stay invested in that fund to be assured of a reasonable return. Now, why should those two numbers be similar? They should be similar because you don't want a 3-year investor, a 3-year time horizon investor invested in a fund that needs a 5-year holding period, because in that case he may not have a decent, he may not be assured of a decent return. So there should always be a match between those two. And now, what decides the holding period of a fund, whether it should be, whether it should have a longer holding period or shorter holding period? What decides is the risk of the investment. So, if it's a higher risk investment, in that case, you need a longer holding period, because it may take a longer time to recover from the losses that it suffers. However, if it's a lower risk investment, then it will probably take less time to recover from the investment. So it needs a shorter time period. So it needs a shorter holding period. Now, with different mutual funds, with different equity funds, we've seen that they need different holding periods. So, for instance, large cap funds need about a 5-year holding period, and so over a 5-year period they've done well. But if you held them for less than 5 years, they may not have done well all the time, although they did do well most of the time. Now, with mid and small cap funds, the corresponding holding period is 7 years. If you can hold them for 7 years, you should do okay. And so, if there's an investor who has a 3-year time horizon, that person should not invest in equity funds, because generally equity funds do need a holding period longer than 5 years. And for that investor, debt funds would be more appropriate. So, debt funds, short-term debt funds, corporate bond funds would be more appropriate. They usually do well over the 3-year period. Thank you.